Ken, welcome back to the show. It is great to have you back.
Hi, Akash.
So let's talk about the ratings agencies. I have a bit of a meta question for you. Okay, lowercase meta, not uppercase meta. If you were to give a rating to the ratings agencies, a letter grade in terms of how effectively they have been doing their job in the context of this AI debt story, what letter grade might you give them?
Well, I mean, so far so good. I'd probably give it an A, which is a pretty good rating. But what they always say is, they put companies on watch for possible downgrades when they're like getting a little nervous. So I think I would keep them on watch for a possible downgrade, just because it's so early in this, and they've really only rated one big complicated bond, and then they've been watching these companies, all the big debt issuers, and so I'd say it's a little early to see how they're actually doing, but the early signs are pretty good.
Right. And the one bond rating you're talking about is meta, uppercase meta this time, right?
Right. Right. So yeah, Meta did this deal in Louisiana to fund this mega $27 billion data center. And they did it because they didn't want more debt on their books. They did it through a special purpose vehicle, which meant it basically doesn't sit on their books, but they borrowed the money. It was a complicated deal. S&P spent a ton of time rating it, and that's really been the first big one, and that's where they've stepped in and joined the party.
Right. Broadly speaking, I'm curious, and I say this knowing that tech companies haven't issued as much debt as they have in other industries. But broadly speaking, I mean, credit ratings around tech companies, they're pretty good, I imagine.
These guys, I mean, these tech giants, Microsoft and Google and all that, they generate so much cash, and they borrow relatively little, that they are pristine credits. There's very, very little risk. We were talking earlier, Microsoft has a AAA rating, which is the highest possible. It's higher than the US government. So like, it doesn't get any better than that. And so, yeah, the credit rating agencies and the bond market generally haven't been that important to tech. I mean, some parts of tech, chip companies borrow and such like that, but the big software companies know. And so this is new. And so this is a test.
Right. And I'm curious for what you might be watching for then as these tech companies move to issue more debt, if that's the way they plan to finance all these capital expenditures. I mean, what sorts of things would bring their ratings down, and what sorts of flags might you be looking for in the scenario where we know ratings agencies, they get paid by these guys in the first place. So, they got to be doing their job properly.
Right. There's an inherent conflict of interest, which is these rating agencies give a rating, but they get paid by the companies that issue the bonds. And so this has been a problem forever. No one's ever solved this conflict of interest. So look, the giant tech companies, they can issue way, way, way more debt than they have issued. There is not going to be anything there. What I'm looking for is smaller companies. Oracle is one. They're on credit watch. They've issued debt and they have commitments. And then so that'll be rated, right? But the biggest question in all of this is all the private credit, the private debt market, which has boomed in the last decade. And they have come in with a lot of, they've issued a lot of debt, and that is not rated, and that is not transparent. And so we just don't know what's out there and what the terms are. And then we have companies like OpenAI, which is committing to a lot of debt and a lot of basically say, we're going to generate $1 gazillion in revenue. We'll be able to pay off this debt. But right now they generate a lot, but not nearly that much. And so those are the areas that we're focusing on.
Who are the big names in private credit that we should be watching?
Well, so it's the big private equity firms like Apollo and Blackstone, but it's also firms like Blue Owl, which it was involved in the Meta deal and has done some other deals. And so there's a bunch of other players out there that specialize in that. And they're very opaque, and it's hard to understand exactly what they're doing. And so we keep asking, but it's going to be a challenge.
Now, you also wrote about how the ratings agencies have been dealing with crypto, and talk a little bit about what are they even rating? You wrote a little bit about Tether, and we know there's the idea that these stable coins are supposed to be backed by reserves, but that's, in my experience, I mean, it's not debt, right? So what exactly are they rating?
So they're not real. They're not bond ratings. They're not credit ratings. Credit the credit rating agencies look at financial stability for these stable coins. So Tether and Circle and some of these others are stable coins, which means they are 1-to-1 against the dollar. They should not be volatile. They're almost like cash, crypto cash, right? And so
Hmm.
the credit rating agencies have gone in and said, well, how likely is it that the value of this thing is going to be 1-to-1 with the dollar? And so they had a rating. They have 5 rating, 1 to 5, 5 being the worst. Tether was at 4. They downgraded it to 5. Tether is by far the world's biggest stable coin. And they did it because Tether owns a lot of very safe stuff to back the stable coins, but they also own some risky stuff. They own Bitcoin, they own precious metals, they own loans, and these are things that are volatile. And so the portion of that they own, the portion of their overall holdings in this risky stuff rose from like 17% a year ago to 25% this year, in the last quarter, most recent quarter. And so they said that's too high. The stability of this stable coin is not necessarily there anymore, and so they lowered it to their lowest possible rating, which is weak.
Right. Last question for you. As you think about all this debt that's being issued, certainly in the AI story, if we come back to that, if you think about the bull case and the bear case of this story, thinking out a year or two from now, what is the bull case and then what's the bear case?
Well, so the bull case is these companies, these giant companies have a ton of cash. The other bull case is it's very early. These guys can write the interest payment checks for the next couple of years out of petty cash. This is not a big deal for them. So nothing probably will happen in the next couple of years in terms of bad debt. What would happen is the market would get nervous and stop funding some of these companies. So say they stopped funding OpenAI, like that would be terrible for that company. It wouldn't be terrible for the credit markets, but it would be terrible for that company. So that's
Right.
the both the bull and the bear case. I mean, the real bear case over time is we see OpenAI doesn't grow as fast as it thinks, and
Right.
also the private credit market, you know, tanks, and
Right.
it's a real surprise. So those are sort of the bear case scenarios.
Great. Well, Ken, I want to thank you for coming on. I think there's lots there to maybe pick up with next week in your next column. So we'll end it there, but we'll talk to you again very soon.
Thank you.